Welcome to LevFin Insights podcast series, Levered Lines. I'm Luke Miller, Global Editor-in-Chief at LevFin Insights. I invite you to listen to our series of podcasts where we interview key market participants as we look across the main themes impacting the leveraged finance markets. And with that, over to the team.
Welcome to LevFin Insights Levered Line podcast. I'm Steve Miller, a member of the CreditSights team at Fitch Solutions. Today we're talking to leveraged finance veteran Chris Bonner about a wide range of market topics. Chris is a Goldman Sachs partner who leads the firm's leveraged finance business in the Americas. Before joining Goldman in 2021, he was a senior member of the debt capital markets team at JP Morgan. Chris is a longtime friend of the family here at Fitch and somebody who's always been very generous with his time and his insights. Chris, thanks for joining us today.
I appreciate it. Look forward to the conversation.
Let's start with a table setter. Let's talk a little bit about your business at Goldman and how you aspire to grow it from here.
Yeah, I mean, listen, we sit in the league tables right now, number 2 globally. It's a business that's a huge focus for the firm. You think about the strong points of Goldman Sachs, historically an M&A related business. Obviously, that continues. We just put out earnings recently, another strong quarter. Equity has been another business, but a huge focus of the firm. And debt is one that we, especially over the last couple of years, has spent a lot of time growing and educating clients on. When I think about where we're looking to take this business, we've been largely a sponsor-related business over the last couple of years. I think we tried to focus more on our corporate business, but again, largely driven by sponsor M&A especially. When you think about really 22 to 25, it's just been quieter in sponsor M&A. As we look to 25, the end of the year, as well as 26 and beyond, I think we expect that part of the market to continue to grow, which should be a tailwind for our business.
That's exciting. And this is a question I've been excited to ask you about. LBO activity seems to be on the upswing. Are you bullish now?
Yeah, I mean, people have been talking about M&A volumes in 2025. Yes, it's been materially higher. I think the bulk of that has been on the corporate side of it and more specifically on the investment grade side. When you look at the second half of 2025, especially a few deals have been announced recently. We just wrapped up Dayforce, Thoma Bravo, public to private that just allocated a few weeks ago. Obviously, announcement of the Silver Lake and PIF acquisition of EA, another large one that was on the tape this morning, Blackstone and TPG buying a business for nearly $20 billion. So we are seeing sponsors slowly wade back in. We've talked about sort of the flavor of an M&A recently. We're seeing really a few different drivers. One, the public to private trend, even with equity prices where they are.
Yes.
Stock market that seems to be higher every single day. I haven't checked it today, but hopefully still going in the right direction.
Yes.
But we are seeing a material amount of public to private. I don't see that slowing down. I think the EA and again, the Blackstone TPG announcement today, I think is all out there, but will be another nice one to sort of have on the tape. Second thing we're seeing more and more of is corporate carve-outs. I think large corporates who have been largely in asset gathering mode over the last 10 or so years are starting to look at some of the slower growing businesses, which are oftentimes stable, good cash flowing businesses, but selling off at some of those divisions, which, candidly for a private equity firm is exactly what they want to buy. Sort of the thesis of underinvested, maybe a cost structure that they can go in and right size, operational expertise. So that's another trend that we're seeing. And both of those two buckets, for the most part, have been sort of in the larger cap, which, in an M&A starved environment, it's nice to see some larger deals come through.
Yes.
And then the last one, which is sort of the other end of the spectrum, which is just smaller, what I'll call sort of traditional private equity. Maybe it's buying a family-owned business or buying a platform deal that then can become a roll-up over time. So those are really the sub-billion-dollar enterprise value businesses, which again, today are sort of smaller in scale, but oftentimes are the roll-ups that sponsors look at, right? Try to buy a series of portfolio companies over the next couple of years and then ultimately divest a business that is, if everything goes right, a lot larger than the billion-dollar enterprise value that starts at.
For sure. Are there particular sectors or segments of the market that you're seeing more active than not?
Yeah, but when I think about our business, one of the busier sectors is in TMT. Obviously, TMT captures a lot these days. You'll see more and more growth into the AI thesis, right? Whether that's data center related, the data centers themselves, which are oftentimes financed in either the bank or CMBS market. But there's also obviously a lot of components that go into the data centers. So a lot of the electronics, a lot of the chips, a lot of the cooling, a lot of the power. So you'll see, I think, that part of the market continue to grow. So TMT has been a huge focus. Consumer retail, which, candidly has been sort of quieter in years past. Some of it's just relative, but some of it's absolute. We are seeing that sector start to pick up a little bit more here. Healthcare, which is honestly, if you'd asked me 10 years ago, what's one of the biggest sectors in leveraged finance? Healthcare was one of those.
Sure.
It's just quieted down a little bit, not good or bad, just sort of a fact. So, that's one that, I think has some opportunity to the upside in terms of growth. And another one I think is going to be an opportunity is going to be industrials, which I know, again, captures a lot. But our industrial sector, which was probably a driver in 23, 24, has just been a little bit quieter in 25. I think as we see a return to sponsor M&A, that's just one of the sectors that sponsors spend a lot of time on. So I think we'll see industrials pick up. But if you were going to ask me for a real hotspot of this year, just in terms of volume, TMT is probably the biggest driver.
That's exciting. So picking up on that, let's talk a little bit about corporates and strategics. We talked about PE. Are you seeing them as better buyers? You mentioned they're potentially better sellers right now.
Yeah, I mean, the corporate carve-out theme I think is real and will continue. Not surprising. I think when you see equity markets at sort of all-time highs, corporate treasurers and corporate CFOs are trying to figure out how do you keep that earnings growth going. As I said, a lot of the carve-outs that we're seeing are some of the slower growing cash flow churning machines being, throwing off a fair amount of free cash flow, which is exactly what sponsors want. But public equity markets, sort of put a premium on growth, especially where we are in valuations. And so you are seeing divestitures of some of those, again, more consistent, stable businesses that aren't seeing the growth. So that's the selling side of it. In terms of the buying side, cost of capital for a corporate is really, really attractive right now.
Sure.
Right? We're living in an environment where, especially on a spread basis, base rates are where they are, but on a spread basis, it's about as attractive as it's ever been, both for investment grade and non-investment grade. Corporates are probably picking up a little bit more of that benefit than sponsors for the obvious part of being a public company usually gets you a little bit lower cost of capital. So you're seeing them be buyers. I wouldn't say aggressive is the right word, but you're certainly seeing corporates be a very competitive dynamic. When you think about when we look at M&A, in sort of the best times for sponsors, it's usually you have 4 or 5 different sponsors are angling for an asset, and maybe you have a corporate. I feel like right now it's a fairly even balance between corporates looking at businesses and sponsors looking at businesses. So the auctions are sort of going down a dual path of do you sell to a sponsor or do you sell to a corporate? Again, in sort of the bull times for sponsors, it's very rare that they're competing genuinely against corporates. Right now, it's a very competitive, again, because of the cost of capital, but corporates are a very competitive threat to the sponsor community in terms of buying assets.
Sounds like it's very competitive out there, which I guess is good. So let's switch gears and talk a little bit about private credit. We're about 10 years into the private credit revolution, I suppose, give or take. How has private credit and all that's going on there changed life for the sell side?
Yeah, I mean, listen, a Goldman advertisement for a second. We have an in-house private credit business, one of the first ones that was out there. It's a huge business that continues to grow and attract new dollars in. So that sits in our asset management division. I feel like I sit in these rooms a fair amount and we talk about broadly syndicated versus private, who's winning, who's losing, who's going to survive, who's not going to survive. And any given day, one's doing better than the other. In my mind, I think, and this is probably the most important comment for sort of the M&A dialogue and the investing community in general, both markets are incredibly healthy right now, right? I mean, obviously, we're watching some of the, I think David made a comment this morning about some of these headlines being idiosyncratic against a few of the fraud scenarios that are working their way through largely in the private markets, not only, but largely in the private markets.
Yes.
So you'll have some headlines and you'll have some hair at times. But when I think about BSL versus private, both markets, again, offer benefits and offer very attractive terms. I still think sort of generically BSL probably 100 to 125 basis points tight of where the private markets are. Privates offer big delayed draws. That's a little bit more difficult in the BSL market. But again, both markets sort of offering their benefits and very efficient. It's mostly up to the sponsor or corporates just to pick which market they want to go into. I don't ascribe to the one's going to win and one's going to lose, or one's going to survive and one's not going to survive. I think we've taken the view, again, partially because of our in-house capabilities, but partially just in our banking business. Both markets are going to be there and they're going to be competitive. And yes, there's going to be a day where we feel better about broadly syndicated. I think we're right now probably in a wave where more people are going towards the broadly syndicated market. That could flip in a second and more people go towards private credit. And so when I sort of rewind the tape probably, 10 or 15 years ago when private credit was a thing, lowercase t, right now it's very much a capital T.
Yes.
We were really setting our business up for we'll offer underwrites for broadly syndicated deals, and we thought a lot less about private credit. We offer out staples or financings for M&A opportunities these days. We think about what does a broadly syndicated deal look like? What does a private credit deal that we can principal look like? What is a private credit deal that you could distribute? Sort of, we think about private credit as, a very small universe. That universe has expanded massively. And I think the lines between broadly syndicated and private credit is probably sort of morphing into lightly syndicated, right? There's more and more players in any of these deals. So there's just a different bunch of flavors that we offer. I think it will help M&A accelerate. I think in times of volatility, having two different markets, again, not dramatically different, but two different markets you can access will help more deals come to fruition. I think for stressed companies who maybe are hitting a window in the refinancing where the market they're in is underperforming and the market that's the one that they're not in is outperforming, it gives them a chance to go back and forth between markets, should provide more stability and less defaults going into a tougher backdrop. So again, I think we think of both markets as equally attractive at times. We're going to go through times where one's going to be better and one's going to be worse than the others. But, we're definitely thinking through our business and making sure that when we're talking to clients about financing, we're very open with them that both markets are available and accessible. And if they want to go do a private credit deal, we can offer them that as well.
You talk about this idea of lightly syndicated private credit, which leads me to my next question, which is around trading liquidity. There's been a lot of buzz about it, but I don't know if there's been a lot of follow through. I wonder your perspective there.
Yeah, listen, we sort of think about the pros and cons of the various markets, right? One of the pros of the private credit market is a sponsor can put a consortium together of, however many they want, right? Between 1 and 5 and sort of the true private credit or the private credit 1.0. And, some of these bigger deals are obviously much broader, but you think back to the original genesis of it, it allowed a sponsor to know who their counterparties were, right? Make sure that, oftentimes putting together multiple deals with the same private credit fund. So you sort of create that relationship.
Yes.
You can create that ecosystem where, both sides relying on the other side just as much, right? The sponsor relies on the private credit fund relies on the sponsor for the assets. They can work very closely together in sort of a portfolio theory. So it's not just one-off transactions. I think as you fast forward the tape, and if the articles are correct and people are focusing more on trading, it just takes one of the dynamics that made people go towards the private credit market away.
Yes.
Right? Sponsors oftentimes went because they wanted to make sure that they were doing deals with people that they had done deals with in the past. I think if you change that and make liquidity easy and accessible, if one of those portfolio companies does have a bump in the night and the sponsor picks up the phone and all of a sudden is not dealing with who they thought they were going to and is calling someone who's a very different type of relationship, my gut is that most sponsors will think I'd rather have less liquidity in that market. And that's one of the reasons I went towards it. Or if there is more liquidity in private credit, it may make them think more about going to the broadly syndicated market. So again, I'm not sure it's necessarily a good or a bad thing. I do think that, as I said, when people do the analysis of which market do I want to be in, when sponsors do the analysis prior to going into one of the markets, it will just make them think differently of private credit if it truly is a liquid market.
Yes.
And the people you're allocating to ultimately may not be the holders if you need to have a negotiation.
That's a fair point. When we think about the syndicated market, have you seen much evolution in the investor base in the last year, and do you expect much going forward?
I mean, I'll go back further than a year,
Okay.
which is be the gray hair comment,
Yeah.
but I think in COVID, it was probably the first time it really turned, right? I mean, if you really want to go back, you went from the prime rate funds.
Yes.
Over time, we had the evolution of CLOs, obviously, mutual funds, adding into the prime rate funds. High yield continued to expand. But I think really when we got to COVID, and they all have different names, but special situations or
Yes.
credit hedge funds or probably names that pre-COVID were maybe 4-letter words in terms of the type of investors and the type of capital they had and the type of returns they went towards. I think when COVID hit, obviously it was fairly violent in terms of the downdrafts. A lot of the more traditional long-only, what I'll say, 2015 to 2020 traditional investors were licking wounds on current marks.
Yes.
And a number of these special situation or opportunistic credit funds were flush with cash, and they stepped in and bought sort of that downdraft or provided capital where it was needed, where candidly the traditional buyer wasn't buying. And I think that was the first real turning point where, we all for years have put together these sort of pie charts of, who are the various buyers at any given time. And, it was mostly loan funds and high yield funds and CLOs and, maybe another bucket, and banks were in there. Now you've diversified the pie chart well enough that I even think if we had another material market dislocation, you've almost created buyers that, and this isn't exactly right, but almost create buyers that will show up every 100 basis points. Meaning a certain buyer is at 8%, whatever the right number is. You move to 9% and you open up a new buyer base. You open to 10%, you open up a new buyer base. That 100 basis point steps feel like they exist everywhere to 15%, right? You now even see, a number of these good companies that have sort of more challenged balance sheets who are out doing pref deals to delever an opco, right? Move a chunk of debt up to a pick at the holdco and then refi the opco. A lot of these credit opportunistic funds are the ones stepping in and buying those. And so I think this diversification of buyers, again, sort of in the same way that private credit has actually added more stability to the market. It provides another layer of more aggressive buyers to the extent that traditional buyers step out. And it's given these shock absorbers where we're not going to, I don't think, have the same 5% moves before somebody steps in, right? You have a more diverse pie chart now where, and maybe in real times of volatility, it's not every 100 basis points they step up. Maybe it's every 200. But at least you know that if you have a material price movement, there's going to be a new type of capital that will step in. And again, I think it's a lot of what you saw and a lot of the reason that the market recovered as quickly as it did during COVID is you had a new set of buyers that all of a sudden stepped in and allowed prices to rally back up. And you didn't have capital raises that were met with basically no demand, right? You had a new set of buyers that stepped in. So I don't know that that's in the last 12 to 18 months difference. Candidly, I'm not sure there has been a huge difference in the last 12 to 18 months. But I think COVID, we saw something that will long-term be a real net positive for the leveraged finance markets.
That's interesting. And I guess, right, if we go back pre-great financial crisis, the real issue that drove everything down when things fell apart was leverage in the system. It doesn't feel like we have that through the mark-to-market CLOs and total rate of return swaps today.
I mean, I think that's exactly right? You don't have the same warehouse risk. You have much better protections on those warehouse risk. I think returns, candidly, unlevered right now are attractive enough that obviously if we see a material base rate shift, which I expect we'll see in 26, but I think the returns right now unlevered are attractive enough that you have most people buying on an unlevered basis. May also, big picture, I think as you talk to accounts right now, the environment we sit in, the spread environment we sit in right now is so tight, right? If you zoom out, basically every market's trading at all-time tights. You'd have to go back pre-financial crisis to get to where we are right now. It's not as if buyers don't understand that, right? Accounts understand that, and they're somewhat defensive, which is why I think when you see negative news come out in the market, you actually see a fairly material move wider right now because I think everyone acknowledges there's nowhere really to go tighter. I said that in the last 18 months. It feels like we've gone sequentially better every day with a few exceptions, but it feels like we're finally getting to the end of the spread tightening. And so most investors are being a little defensive right now, right? Really buying up in quality names, trying to limit any sort of volatility in their portfolio. Feels like almost overpaying for really strong names versus chasing more return for a name that's a little bit more challenged or could have, a real price step down if they missed earnings or something. And so most of the buyer base is being really defensive, which is part of the reason I think you just don't see the same amount of leverage buried in the system right now.
Yeah, that makes a lot of sense. So one question I'd like to ask on these podcasts, and it gets a lot of play, is advice for younger people. So if you think about people coming up now, want to pursue a leveraged finance career on the sell side, what's your advice to them, and how has that changed since you were a young guy starting out?
Yeah, I mean, general advice, and this does make me feel old, but a general advice I'd say right now is find something that's interesting. I've been doing this for 20 plus years at this point. if you sort of think big picture, it's loans and bonds, right?
Yes.
It's LBOs. I've worked on however many of those, and they all have a little bit of a different flavor to it. And so that's one of the things that I think is exciting about leveraged finance is every deal feels a little bit different, right? There's always a different aspect. You sort of get to meet different players, both the competitors and customers. You sort of learn how to live in the ecosystem. You have some fun deals, you have some tough deals, you have some easy deals. There's a bunch of different flavors that, again, every day sort of feels like a new challenge. So whatever it might be, that's not a pitch for leveraged finance. It's a general pitch for find a job that's interesting. I also think finding someone you want to work with is a really important part of it, right? I think about that when anybody interviews anywhere or walks around our floor, in any given bank, we all work in buildings that are 50 stories.
Right.
Every floor has a different feel to it. Every group has a different feel to it. You have to feel comfortable and willing to come in every day and work with those people and be excited to come to work the next day. And, surrounding yourself in not only a job that's challenging, a job that's interesting, but also people that you feel are really good role models and really good mentors to you, I think is probably the most important piece to it. Again, the pitch for leveraged finance is it keeps evolving, and it's a market that, as I said, if you zoomed out, it's probably not that different than when I started, and you zoom in, it's a whole lot different than when I started.
Yeah.
And I still enjoy it, and again, I still surround myself with a bunch of really interesting, really smart, really driven people. And I think for anybody, leveraged finance in general, advertising, whatever else you want to do, surrounding yourself with really good people is probably the most important thing. If you don't like getting up and going to your job in the morning, it's not going to be a long career in that industry.
That's a really fair point. Well taken. So as long as we have you here, I can't resist but to ask you about your outlook here as you look to the home stretch of 2025 and 26 on around leverage finance, spreads, volumes, that sort of thing.
Yeah, I mean, we've been, I joked at the beginning of 25 that every M&A banker wrote an article about how 25 was going to be great because 24 wasn't, and they probably wrote that in 24 when
That's
23
fair.
wasn't. So, maybe this is the definition of Chicken Little, but you finally get to a point where it does feel like, back to your first question or so, M&A is here. It's certainly picking up steam. Sponsors are more active. Corporates are more active. Financing market is about as receptive as it could be. Regulatory backdrop, I think people just feel better about right now. Economic growth, people feel better about. Rates going down, that should help spur more M&A. So as much as I don't want to say it's going to come next year because it didn't come this year, everything's sitting at about as close to perfection as it could. There's obviously a lot of macro headwinds that we're all struggling with. I'm not sure, they're different every day. I'm not sure in numbers they're that different, right? We've had a lot of macro headwinds for a long time here. And the technical in the leveraged finance market, lack of supply, seemingly endless demand, it has driven a market tighter and tighter every single day in spite of what's going on in the large world. Obviously, Liberation Day was one of the unsettlings of that. We've had a number of geopolitical elections, whatever it might be. There's been a lot of things we've thrown at it, but those periods of volatility continue to get shorter and shorter. I think in general, 2026 should be a really good year for M&A. I think we're seeing that internally. Part of the benefit of working in a place where M&A is such a big part of our business is while you don't always see it announced today, we see it fairly early in the processes. And yes, it's weeks or months, not days, between start of a process and the process coming to fruition or a deal getting signed. Not everything's going to get signed, but we're seeing a huge pickup in M&A activity right now. Sort of live the life cycle of those, that probably means we'll start to see an uptick in announcements in early 2026. So I think M&A is going to be a huge pickup. Perfectly timed refinancings should fall off.
Yes.
Right? I mean, the loan market, we've essentially refinanced almost everything once, twice, if not three times. High yield bond market's a little bit trickier just because of prescribed call structures. But again, that market has largely dealt with expensive COVID capital structures, and things that had maturities have largely been pushed out. So there isn't as much obvious refinancing that's left to go, right? Spreads are largely at all-time tights. And so M&A is going to have to be the driver of 2026. And everything we're seeing in terms of green shoots of auctions or sale processes tells us that 26 should be a great year for issuance.
That's exciting. And just to pick up on one piece that you didn't touch on, dividends was certainly a huge piece of the pie in the third quarter. You seeing a lot more push to that as well?
Yes. To some extent, right? I think when you think about the life cycle of a private equity investment, the old business model of own a company for 3 to 5 years and monetize it, right? If you sort of think traditionally it was go take it public. The average private equity investment right now is 5+ years in the tooth, and everybody's trying to figure out, how do I get out of it? That should be an argument for dividends picking up dramatically.
Yes.
The counter to that is we have seen a resurgence in the IPO market.
Yeah.
And so when you try to balance time to exit, i.e. DPI, people want to return capital to their investors. A lot of funds trying to fundraise, a lot easier to fundraise when you return capital than it is to have not returned any and go ask for more. But dividends, by default, take leverage higher. And when you take leverage higher, it's that much harder to go public, or you're taking leverage higher right in front of paying down debt so that you can go public.
Yeah.
So I do think, we've seen a huge pickup in dividends. I think that huge pickup is a very relative comment. I think on absolute basis, it's still relatively light.
Fair enough.
And when I think through sort of what the biggest impediment, because logically, if you want to return capital, it's one of the easiest ways. Obviously, a sale process or an IPO takes a little bit more time. Dividends can be done in a matter of days and weeks. I think the biggest impediment to dividends picking up dramatically is going to be, I think most private equity funds will feel like the time to exit is closer now than it's been in a long time, meaning M&A is going to pick up and the IPO market is opening. Why would I pick the time as now to take a small dividend?
That's fair.
To affect either of those two potential outcomes, which are obviously a much easier organic way to actually return capital to your investors.
So last question, and then we'll let you go. Talk about rate cuts. If we're really looking at 50, 100 basis points of rate cuts, how does that impact the whole picture?
Yeah. So, I think about sort of the two markets. If you think about loans and bonds. When you look at and I'll start with bonds. When you look at bond spreads right now, and I'm sure there's a mathematical person who will tell me that I'm wrong in this, but I'll say it. It feels like the bond market, with where spreads are right this second, most investors are buying all-in coupons that are already 1 to 2 rate cuts ahead.
Oh, interesting. Okay.
Right, meaning they're buying artificially low spreads because in the anticipation of base rates to go down, and those spreads will feel more normalized.
Yep.
Long-winded way of saying I don't think we see a material improvement in the high-yield index as we get rate cuts here.
Interesting.
I think it'll sort of lag. On the loan side, obviously, you benefit from it anyways, and so less of a focus. Although I do think, and again, it gets back into this sort of big soup of what ultimately will drive more true net issuance or drive more M&A issuance, is people will just feel better in an environment where rates are going down, that it's better for companies, it's better for leverage profiles, it's better for free cash flow, it's better for M&A. It will just help the issuance backdrop. So I don't know that, I think most people have sort of gotten their arms around, we're going into a rate cutting cycle, we're going to have more, we'll have hopefully a little bit here before the year's over. I think we're going to be in a much healthier backdrop next year. And again, just from a sentiment point of view, I don't think it's really going to change cost of capital, but I think seeing a few rate cuts will just help the sentiment that the market's in a better position and the economy's in a better position. Lower rates are going to help drive growth, which should help people pay a little bit more for their private equity investments.
Well, that's all the time we have. Thanks, Chris, for making this time for us and for your excellent insights. We really appreciate it. I hope our listeners learned as much as I did.
I appreciate it. Thank you for the time.
This podcast should not be copied, distributed, or reproduced in whole or in part. Neither LevFin Insights nor its affiliates makes any representation or warranty as to the accuracy or completeness of any information contained in this podcast. LevFin Insights is not providing investment, legal, accounting, or tax advice. LevFin Insights is not providing research or making any recommendations, nor is LevFin Insights offering or soliciting any transaction with respect to the purchase or sale of any security that the listener may hold.